Two guest hosts with us today, Nouriel Roubini, who's chairman of RGEmonitor.com, also professor of economics at NYU Stern School of Business, and Jack Rivkin, the former Neuberger German CIO. Nouriel, you're the new face at the table right now, so why don't we get your outlook just about the market in general? We know that you had been very pessimistic, expecting a lot of bad things to come. Have we gotten through the worst of it yet?
No, I believe that the worst is still ahead of us. I think that the next few weeks and months are going to be negative surprises on the economy. I think the flow of macro news is going to be much worse than expected, like it happened last week where every single piece of macro news was awful. I think that overall the earnings news are going to surprise on the downside. There's going to be a sharp fall in earnings, not just financial sector, but also for the non-financial corporate sector. And even in the financial system, we avoided the systemic financial meltdown by an epsilon. There'll be significant risk downward. Emerging markets going into a crisis, having a blow-up of the CDS market, having hundreds of hedge funds having to close down. So I see significant downside risk for financial markets and for the economy. I think the worst is still very much ahead of us.
So the front page of the Wall Street Journal today points out that California home sales are starting to revive. Granted, it comes at a very steep price, but we heard yesterday from a developer in Florida that some of these places are going for 30 cents on the dollar, and they believe that these hardest-hit markets have bottomed when it comes to home
Listen,
prices.
Half of those sales in California are essentially foreclosures or short sales, and prices are collapsing. That's not a sign of revival of the housing market. Most of the sales are not right now distressed sales. I mean, the housing is still a disaster.
Is there more distressed sales to come? Will the number of foreclosures increase from here?
Of course, we're going into a severe recession. There are going to be about 40% of all households that have a mortgage going to be in negative equity, underwater with the value of their homes below the value of their mortgages. There's a huge incentive to walk away from your homes. The financial cost of that walk-away phenomenon might be another $400 to $500 billion losses for the financial system. Housing is a disaster, and the collateral damage to the financial system is going to be very, very severe. And it's not just subprime anymore. Subprime, near prime, prime, old age, jumbo loans, home equity loans, you name it. It's just a disaster, and it's getting worse. It's not getting any better, frankly.
Jack, I know you're cautious, but you are not quite as pessimistic about things.
I think what Nouriel is saying is right in terms of what we're going to see over the next few months. We're not, everybody's looking for instant gratification. We're not anywhere near the bottom here in terms of the economy. But in terms of the stock market, it all depends on if this economy is going to, we're going to find ourselves in a very steep V bottom here and come out of it, or whether we're just going down and staying there forever. I just don't believe we're going to go down and stay there forever. We're going to go down.
I mean, the risk is that there's not going to be a V. I mean, frankly, there is going to be a short and shallow recession, 6 to 8 months, is out of the window. Right now, we're in a U-shaped recession. It's going to last at least 2 years, in my view. Last two lasted only 8 months. This is going to be 3 times as long, 3 times as deep. And the risk is actually going to end up like Japan after the bursting of its real estate and equity bubble, an L-shaped recession. That's the risk we're facing right now.
An L-shaped recession that lasts for about a decade? Is that what you're...
Not a decade, but even if we're going to recover out of this recession, growth could be so much below potential that for a while it's going to feel like a recession, even if we're not in a recession. If the financial system remains impaired, if the credit growth doesn't resume, there's not going to be enough credit for the corporate sector, for the household sector, and the growth will be
What about
shallow.
all the steps that the government has taken, even yesterday, trying to back up the commercial paper market? Is that something that could change the outlook? Is that something that could change the path for where we're headed?
To me, it's a signal of desperation. Now we have to provide another $500 billion to the money markets because there has been a redemption of $500 billion. It's a sign that things are not improving. There is still significant panic in the markets. Say, yes, we avoided the systemic financial meltdown. 2 weeks ago, we were literally 1 epsilon away from a systemic meltdown. That doesn't mean that everything is fine. It means the economy is going to be in a nasty recession, much worse than otherwise. It's not just the U.S., it's Europe, it's Japan, it's Canada, it's New Zealand, it's UK, and it's going to become a global recession.
I don't think anybody's going to argue with you that you're going to be looking at a weaker economy, but the steps that the government has taken, will it shorten the length of the recession? Will it prevent what we're seeing here from becoming another Japan?
Oh, the probability of ending up like Japan has been reduced because of the backstop of the financial system, but we're going to have a severe recession. If this is going to be a 2-year recession, that's not priced by the market. There are significant downside risks for the stock market, for credit markets, in my view. Yes, we're going to avoid the Great Depression. We're going to avoid maybe a 10-year stagnation. That's not going to be the case, but if we're going to have a recession for 2 years, and then the recovery is going to be very shallow, it's going to feel like a recession. Take the last time around, in 2001, recession was on.
You've been on before calling for much bleaker outcomes, right? So we're not looking at financial Armageddon necessarily anymore, right?
I say that,
because of the
2 weeks
policy
ago, 2 weeks ago, we were close to a systemic financial meltdown.
Right. And that's
then
off
the
the
G7
table.
and the EU, it depends. There are still significant risks. There are some financial institutions that are systemically important that could collapse. We're going to maybe bail them out, but it's going to be significantly costly. You could have hundreds of hedge funds going belly up, putting downward pressure on stock prices because they're going to sell in a liquid market. You could have a blow-up of the CDS market. I don't think that the sources of systemic risk have been eliminated. They've been reduced, but they're not eliminated.
All right. No, I would agree with that. We're still going to see a few headline financial problems coming out of this. But, Nouriel, 2 years of a recession, are you saying 2 years of negative, real?
Yes. I believe we're going to have 2 years of negative economic growth. The last two recessions lasted only 8 months each. Right. In 2001 was from March to November, and job losses continued all the way through August of 2003.
Yes, they always
for 2 years. It was a job loss recession for a recovery for a while. This time around, this is going to be 3 times as long, 3 times as deep. This is going to be the worst recession the U.S. has experienced since the 1980s.
Where's oil?
I think it's
going to be at this?
I think it's going to be deep.
Oil.
I'm not
oil,
so sure.
Oil, I think, is going to be below 50 at the
bottom. Oil will be below 50.
Yeah, absolutely.
Other commodities?
Other commodities are going to fall another 20% from the current levels in this situation. 3 months ago, we worried about inflation. In 6 months, we're going to worry about deflation. You'll have slack in goods market, slack in labor markets, slack in commodity markets. All sorts of sources of inflation are going to go away. We're going to start worrying about stag deflation rather than stagflation. A situation of
stag deflation.
Yeah, economic stagnation and deflation. Gold is going to be 20% lower because it's going to be falling like all other commodity prices.
What about the unemployment rate?
I see the unemployment rate peaking around 8.5% to 9% at the bottom of this recession. I think it's going to be that severe. I think we don't really fully recognize right now this is going to be the worst recession we've had in decades. And it's not just the U.S. It's all the advanced economies. All the advanced economies were already contracting in the second quarter before the financial shocks of September, October. So think of what's going to happen now to the real economy in Europe, in Canada, in Japan, New Zealand, in Iceland, in Eastern Europe, in emerging markets. You've had a significant growth slowdown in China to 9%, worse than expected. And that's just the beginning. If
Why are people buying the dollar like it's going out of style?
Because they're getting out of emerging markets. There is flight to safety. They're going back home. There's a really significant fall in equity prices.
But that says something about us relative to other economies, right?
It means that, we are in deep trouble, and now Europe and Japan are in even deeper trouble. That's not good news for us, because the only thing was growing in the U.S. was net exports. But if there's going to be a severe recession abroad, our exports are their imports, and their imports are going to start falling. It's going to make the recession worse in the U.S. That's recoupling at work
in financial
markets and real economy.
If you guys disagree on duration, right, you think it's going to be maybe deep but not lasting long? What's going to pull us out?
I think it's going to be very deep. Well, what's going to pull it out is exactly what Nouriel is talking about. All these prices are going to go down. You get the prices of raw materials going down. You get people being able to feel better about what they're paying for things. I think you're going to, and you get stimulus. Whoever's president is going to have to throw their package out the window and just deal with stimulus. I think you could see a V recovery here, but it's going to be from a very sharp level. Well, all right, this helps. When am I going to start buying? When you've got 4 or 5 other respected economists like Nouriel. Maybe that's difficult to find. But if you've got 4 or 5 others that start saying the same thing that he's saying, then that's when I start buying stocks. Because that's when
saying that things are going to get much worse?
Things are going to get terrible. And when you have enough people saying that, then guess what? We're done.
I can think of Rosenberg at Merrill Lynch, right, Joe?
It's been negative,
yeah.
The folks at the Goldman Sachs, Hatzius and that crowd is also quite negative about the economy.
Well, that's because of their book, but no.
Schiller.
That was a joke. That was a joke. That was what someone who wrote that. The Bueller.
I think the odds are growing.
Marty Feldstein, Paul Krugman, Bob Schiller.
It's going to be a V.
There are plenty of people out there who are very negative.
It's going to be a V.
Well, for those out there that keep writing us at the cheerleader mail, hopefully you're watching today. Pom-poms aren't around today. It's actually 50-50 between doom and gloom,
I think we're doom and gloom.
and people that, depending on what their book is,
right.
what their book is at home. We are going to have an extended segment coming up with Jack Ferrugian to offset what we just heard from Nouriel. We're trying to get him on the phone right now.
Oh boy, Nouriel's going to be with us for the rest of the show. So's Jack. Yeah, this is...
Sorry, I shocked you.
Yeah, Jack was already here earlier today, so...
God, call him back.
He's gone.
Jack, we hope you're still there.